Welcome to Chapter 15, Options Markets. Options are rights, not obligations. That asymmetry is the feature that makes them useful, flexible, and occasionally dangerous. A call gives its owner the right to buy. A put gives its owner the right to sell. The holder may exercise when the contract is favorable and walk away when it is not. The writer, by contrast, receives the premium and accepts the obligation. One side owns a choice, the other side has sold that choice. You already understand the basic idea outside finance. A refundable hotel reservation gives you the right to use a room at an agreed price, but not the obligation. Insurance gives you the right to make a claim if a covered loss occurs. An option applies the same logic to a stock, index, futures contract, interest rate, or currency. The difference is that financial markets attach a continuously changing price to the right itself. This chapter focuses on the decision system. What is the underlying asset? Which direction or amount of movement benefits the position? What happens at expiration? How does the premium change payoff into profit? What is the maximum gain, maximum loss, and break-even point? Most important, what job is the strategy supposed to perform? Options often attract attention during fast markets. In the early 2021 meme stock episodes, short-dated calls became part of the story because option demand could affect dealer hedging and amplify already dramatic price moves. That did not repeal the basic math. Some traders made extraordinary gains. Others were correct about direction, but wrong about timing, strike price, or the amount of movement needed to recover the premium. The market can agree with your opinion one day after your option expires, which is finance's way of saying that being right eventually is not the same as being profitable. Our goal is not to label options as insurance or gambling. The same contract can hedge a pension portfolio, help an executive, limit concentrated stock risk, generate income, or create a highly leveraged speculation. The contract is neutral. The purpose, price, position, size, and risk controls determine the result. By the end of the chapter, you should be able to read an option position as a payoff structure rather than a mysterious ticker. We will move from contract language to expiration payoffs, then to strategies and embedded options. Keep one question in mind throughout. What would have to happen for this position to help, and what could make it fail? This module has 4 learning objectives, and each one moves from vocabulary toward judgment. First, you should be able to define calls, puts, strike price, expiration, premium, and moneyness. These terms are the grammar of the options market. A call is the right to buy the underlying asset at the strike price. A put is the right to sell. Expiration tells us when the right ends. The premium is the price paid for the contract. Moneyness describes the relationship between the underlying price and the strike. A definition is necessary, but it is only the starting point. Second, you should be able to calculate payoff and profit at expiration. This distinction matters. Payoff describes what the option is worth at expiration based on the stock price and strike. Profit includes the premium paid or received. A call can finish in the money and still lose money if the payoff does not recover the premium. That is one of the most common errors in options analysis, and it is the financial equivalent of celebrating gross revenue before checking expenses. Third, you should be able to explain major strategies, including protective puts, covered calls, straddles, spreads, and collars. Each strategy reshapes the distribution of outcomes. A protective put buys a downside floor. A covered call exchanges some upside for premium income. The straddle seeks a large move in either direction. A spread combines options to lower cost or define a payoff range. A collar places a floor under the stock and a ceiling above it. The correct question is not which strategy sounds sophisticated. It is which payoff fits the investor's objective and constraints. Fourth, you should recognize option-like features inside other securities. When a company issues a callable bond, the issuer effectively owns an option to repurchase the bond under specified terms. That option can limit the investor's upside when rates fall. A convertible bond gives the investor a route into common stock if the equity performs well. Options on futures provide the right to enter a futures position at specified terms. Once you recognize the embedded option, the security's behavior becomes easier to explain. The assessment focus is application, interpretation, and judgment. On the homework, a strong answer will calculate the payoff correctly, include the premium, identify the maximum loss, and break even point, and explain why the strategy fits the scenario. The discussion asks whether options are insurance or gambling. A thoughtful response should reject the false choice and explain how purpose, leverage, transparency, and position size determine the answer. The quiz checks the core mechanics. Do not worry about memorizing every possible combination. There are enough name strategies to make a restaurant menu look concise. Learn the building blocks, then reconstruct the strategy one leg at a time. The chapter is organized around 4 connected questions. The first question is about contracts. What right has been purchased, what obligation has been written, and what is the underlying asset? A call gives its holder the right to buy at the strike. A put gives its holder the right to sell. The contract also specifies expiration and exercise style. American-style options generally may be exercised before expiration, while European-style options generally may be exercised only at expiration. The names describe exercise rules, not geography, because finance enjoys making simple labels work over time. The second question is about expiration payoffs. Options are asymmetric. A long call cannot have a negative payoff at expiration. It is worth either 0 or the amount by which the asset price exceeds the strike. A long put is worth either 0 or the amount by which the strike exceeds the asset price. The premium determines whether that positive payoff becomes a profit. Payoff diagrams make this asymmetry visible and help us identify maximum gain, maximum loss, and break-even points. The third question is about strategies. Options can hedge, generate income, or speculate on direction and volatility. A protective put combines stock ownership with downside insurance. A covered call earns premium but sells away upside above the strike. A long straddle buys a call and a put with the same strike and expiration, so it benefits from a sufficiently large move in either direction. A bull call spread buys one call and writes another at a higher strike, lowering the initial cost but capping the gain. A caller combines stock, a protective put, and a written call to create a range of outcomes. The fourth question is about embedded options. Callable bonds, convertible bonds, warrants, employee stock options, and options on futures all contain or create option-like claims. A callable bond may perform poorly relative to a non-callable bond when rates fall because the issuer can refinance. A convertible bond may participate in equity upside because the bondholder controls the conversion choice. The label on the security may say bond, but the risk can include a meaningful option position hiding inside the contract. These 4 questions should be used in sequence. Start with the legal right. Translate it into a payoff. Add the premium to determine profit. Combine the legs, then decide whether the result fits the investor's purpose. This sequence also prevents a common mistake, beginning with a strategy name and assuming the risk. 2 callers with different strikes can create very different floors and ceilings. 2 covered calls with different expirations can produce different income, assignment risk, and tax consequences. The name is a folder. The contracts inside the folder determine the actual exposure. The goal is a usable mental model, not a vocabulary list. When a new strategy appears, you should be able to take it apart and rebuild the payoff from the individual positions. Let us put the core concepts into one view. A call option gives the holder the right to buy the underlying asset at the strike price. The call becomes more valuable at expiration as the underlying price rises above the strike. A put option gives the holder the right to sell at the strike. The put becomes more valuable as the underlying price falls below the strike. The strike price is the contract price at which the holder may buy or sell. The premium is the price of the option itself. Keep those two prices separate. The strike governs the future transaction. The premium is paid today for the right. Calling both of them the price is a reliable way to make an easy problem. Feel like tax law. Moneyness compares the underlying price with the strike. A call is in the money when the underlying price is above the strike, because immediate exercise would create positive value. A put is in the money when the underlying price is below the strike. At the money means the underlying price is near the strike. Out of the money means exercise would not create positive value. Moneyness describes intrinsic value, not profitability. A call can be in the money by $2 and still lose money if the buyer paid $5 in premium. A protective put combines a long position in the asset with a long put. The stock preserves upside participation, while the put establishes a minimum sale price at the strike. The premium is the insurance cost. Like most insurance, it feels expensive when nothing bad happens, invaluable when something does. Buying protection after volatility has already exploded can resemble buying homeowners insurance while the fire department is in the driveway. The coverage may still matter, but the price will know why you are calling. A straddle combines a call and a put with the same strike and expiration. A long straddle does not require the investor to predict direction. It requires the price to move far enough in either direction to recover both premiums. This is why an earnings announcement can produce a dramatic stock move and still disappoint a straddle buyer if the move was smaller than the option market had already priced. Spreads combine long and short options. The short option can reduce the premium paid, but it also changes the payoff and may cap the gain. A caller combines a protective put with a written call around a stock position. The premium from the call can offset part or all of the put costs, but the investor gives up upside above the call strike. Finally, remember the holder-writer relationship. The holder pays the premium and owns the right. The writer receives the premium and accepts the obligation. For a long option, the maximum loss is generally the premium. For an uncovered written call, the potential loss can be extremely large because the underlying price has no fixed ceiling. A strong analysis does more than name the concept. It explains how the concept changes, the investor's outcome, what the contract costs, and what risk remains. A repeatable options workflow has 6 steps. Step 1 is the underlying. Identify exactly what the option references: a stock, an index, an exchange-traded fund, a futures contract, an interest rate, or a currency. The underlying determines the economic exposure, settlement mechanics, trading hours, and sometimes exercise style. An index option may settle in cash, while an equity option may result in stock delivery. Similar looking tickers can create very different operational outcomes. Step 2 is direction. Ask whether the position benefits from a price rise, a price decline, or a large move in either direction. A long call is bullish. A long put is bearish or protective. A long straddle seeks volatility rather than direction. A covered call is mildly bullish to neutral because the investor keeps the premium but gives up gains above the strike. Direction should be stated before any formula appears. Step 3 is payoff. Calculate each leg at expiration. For a call, compare the stock price with the strike. For a put, compare the strike with the stock price. For stock, the terminal value moves dollar for dollar with the price. For a multi-leg strategy, calculate each position separately, then add the results. This is slower than guessing from the strategy name and much faster than explaining a preventable mistake later. Step 4, is premium. Convert payoff into profit by subtracting premiums paid and adding premiums received. Premium is not a footnote. It determines break even and often explains why a correct market view did not produce a profit. Options markets are forward-looking. When everyone expects a dramatic earnings move, the premium may already reflect that excitement. Step 5 is risk. Identify maximum gain, maximum loss, and break even. Ask whether the position can be assigned early, whether the option may expire worthless, and whether one listed contract represents exposure to many shares. In many U.S. equity options, a standard contract represents 100 shares. A $3 premium may therefore mean $300 per contract before fees. The decimal looks small because it brought friends. Step 6 is fit. Decide whether the strategy appropriately hedges, speculates, or generates income. Fit includes time horizon, liquidity need, tax setting, position size, and the investor's ability to monitor the position. A protective put can be sensible for a concentrated stock position with a known spending date. The same put may be an expensive habit for a diversified investor who repeatedly buys short-term protection and lets it expire. Consider the 2022 market decline. An investor worried about downside could have reduced the stock allocation, purchased puts, or used a collar. Each choice carried a different cost and opportunity set. The put preserved upside but required premium. The collar reduced the premium but capped recovery. Selling stock avoided option complexity but changed the strategic allocation and could create taxes. There was no free hedge, only different invoices. Process discipline turns chapter vocabulary into a repeatable workflow. Underlying, direction, payoff, premium, risk, fit. Follow those 6 steps and the strategy becomes much harder to misunderstand. The key relationship on the slide is the call payoff at expiration. It equals the stock price at expiration minus the strike price, or 0, whichever is greater. Suppose a call has a strike of $55. If the stock finishes at $50, exercising would mean paying $55 for something worth $50. The holder simply lets the option expire, so the payoff is 0. If the stock finishes at $62, the holder can buy at $55 something worth $62. The payoff is $7 per share. Now separate payoff from profit. If the call premium was $3, the $7 payoff produces a $4 profit per share. The call buyer's break even at expiration is the strike plus the premium, 55 plus 3 or $58. Above 58, the position has a profit. Between 55 and 58, the call has a positive payoff, but the buyer still has a net loss. Below 55, the call expires worthless and the buyer loses the $3 premium. The long call's maximum loss is limited to the premium. Its potential gain is theoretically unlimited because the stock price has no fixed upper bound. The call writer has the mirror image. The writer's maximum gain is the premium received. An uncovered call writer faces potentially very large losses. If the stock rises sharply, premium income can look calm right up until it discovers leverage. For a put, the payoff at expiration equals the strike price minus the stock price, or 0, whichever is greater. A put with a strike of $45 has no payoff if the stock ends above 45. If the stock ends at 35, the payoff is $10 per share. If the premium was $2, the profit is $8. The long put's break even is the strike minus the premium, $43 in this example. The writer relationships again reverse the holder relationships. A put writer receives the premium and may be obligated to buy the stock at the strike. If the company collapses, the short put can lose substantially. The maximum loss is approximately the strike price minus the premium received if the stock falls to zero. That is not unlimited, but it can be painful enough that the word limited offers very little emotional support. One more distinction matters. The formulas on this slide describe expiration. Before expiration, an option can have time value even when immediate exercise would produce no value. Volatility, time remaining, interest rates, dividends, and supply and demand can all affect the option price. Chapter 16 will address valuation before expiration. Here, we are building the expiration foundation. When you calculate, state the unit. Is the answer per share or per contract? If one contract represents 100 shares, a $4 per share profit equals $400 per contract before fees. Clear units prevent a small arithmetic answer from hiding a much larger economic exposure. A protective put and a covered call both begin with stock ownership, but they solve different problems. The protective put combines a long stock position with a long put. The investor pays a premium to create a floor. Suppose the stock costs $50 and a $45 put costs $2. The total initial cost is $52. At expiration, if the stock is above 45, the put expires and the investor still owns the stock. If the stock is below 45, the put allows the investor to sell at 45. The floor protects the terminal value, but the premium means the maximum loss is $7 per share, 52 invested minus 45 recovered. The protective put preserves upside, less the insurance cost. If the stock rises to 70, the investor participates in the gain and loses only the $2 premium on the put. This can be valuable when the investor wants to keep the stock but cannot tolerate a severe decline before a known date. It is particularly relevant for concentrated positions, pending expenses, or investors who value a defined floor. The covered call combines long stock with a written call. Suppose the investor owns the same $50 stock and writes a $55 call for $3. The premium lowers the effective cost basis to 47. If the stock stays below 55, the call expires and the investor keeps the premium. If the stock rises above 55, the writer may have to sell at 55. The strategy has generated income, but the upside is capped. The covered call does not eliminate stock downside. If the stock falls to 30, the investor has lost $20 on the stock and received only $3 of premium. The net loss is $17. Calling this risk-free income is like calling a coupon a free lunch while ignoring the restaurant bill. The strategies can be compared by purpose. The protective put pays premium to defend the downside and keep the upside. The covered call receives premium to cushion modest downside and gives up upside above the strike. One buys insurance. The other sells part of the future appreciation. A collar combines the two. Own the stock, buy a lower strike put, and write a higher strike call. The call premium can finance part of the put. The result is a range. Downside is limited below the put strike, and upside is capped above the call strike. A collar can be useful when preserving a minimum value matters more than retaining unlimited upside. The better choice depends on the job. Ask what risk the investor cannot accept, what return the investor is willing to surrender, how long protection is needed, and whether assignment or taxes matter. There is no universally best strategy. There is only a payoff that either matches the objective or does not. Options have moved from a specialist corner of the market into mainstream investing. The slide notes that the Options Clearing Corporation reported 15.2 billion options contracts in 2025, an increase of 24.4% from 2024. That scale makes payoff literacy a core investor skill, not an elective topic for derivatives traders. Several things changed. Trading platforms reduced access barriers. Weekly and very short-dated expirations created more precise ways to express views around earnings economic releases, and intraday moves. Institutional investors increased their use of options for hedging, volatility management, and structured outcomes. Retail investors gained easier access to contracts that once felt remote. Market makers and electronic systems became central to translating option demand into hedging activity in the underlying market. Some things did not change. The buyer still pays a premium. The writer still accepts an obligation. Time still runs in one direction. A correct forecast still needs enough magnitude and enough speed to overcome the premium. Leverage still cuts both ways. The technology may be newer, but expiration remains gloriously indifferent to the investor's explanation. The early 2021 meme stock episodes showed how options can interact with the stock market. Heavy demand for calls may lead dealers to buy shares or adjust hedges as prices move. That feedback can contribute to rapid price changes, but the same episode also showed why option buyers need to understand premium, volatility, and timing. And buying a call after implied volatility has surged can be expensive. Even a rising stock may not create the expected profit if the move is too small or arrives too late. Who benefits? Long-term investors can use protective puts or collars to define downside around a spending date. Portfolio managers can use index options to adjust market exposure without selling every security. Companies and institutions can hedge currency, rate, or commodity risks. Income-oriented investors may use covered calls. Speculators can take directional or volatility views with limited initial capital. What risk remains? Short-dated options can encourage frequent trading and overconfidence. Written options can create obligations larger than the premium makes obvious. Liquidity can vary dramatically by strike and expiration, bid-ask spreads. Early assignment, taxes, and operational mistakes can matter. Very short-dated positions leave little time for a thesis to work and can behave more like event bets than investments. There is also a behavioral risk. A $300 option can feel safer than buying $5,000 of stock because the dollar outlay is lower. Yet the entire $300 can disappear quickly. Small ticket size is not the same as small risk. It may simply package 100% downside in a more convenient box. Modernization should not mean chasing the newest contract. It means asking 4 durable questions. What changed? What stayed the same? Who benefits? And what risk remains? The answers keep the technology in perspective and the payoff at the center of the decision. Let us work through the practice case. The stock trades at $50. A call with a $55 strike costs $3. A put with a $45 strike costs $2. First task, compute the call payoff if the stock finishes at $62. Pause and compare the expiration price with the strike. The call is $7 in the money. The payoff is 62 minus 55, which equals $7 per share. Second task, compute the call profit after the premium. The investor paid $3 for the option. Profit is the $7 payoff minus the $3 premium, or $4 per share. The break-even price is $58, equal to the $55 strike plus the $3 premium. At 62, the stock is $4 above break-even. The call buyer's maximum loss is the $3 premium. If the option expires below 55, the payoff is 0 and the premium is lost. If a standard contract represents 100 shares, the $7 payoff equals $700. The premium cost equals $300, and the profit equals $400 before fees. Third task, explain when the put finishes in the money. The $45 put is in the money whenever the stock price at expiration is below $45. At $40, the put payoff is $5. At $30, the payoff is $15. At or above $45, the expiration payoff is 0. Because the put costs $2, the standalone long put breaks even at $43. Fourth task, describe a protective put using the stock and the put. The investor buys the stock at 50 and buys the $45 put for 2. The total initial cost is $52 per share. The investor keeps the stock's upside, but establishes a $45 terminal floor during the life of the option. If the stock ends at 62, the put expires worthless, and the position is worth 62. The profit is $10 per share, equal to 62 minus the $52 combined costs. If the stock ends at 40, the put is worth 5, and the stock is worth 40. Together, they are worth 45. The loss is $7, equal to the $52 cost minus the $45 floor. If the stock falls to 0, the put pays 45, and the combined position still ends at 45. The maximum loss remains $7 per share. The protective put break even is $52 because the stock must recover both the $50 purchase price and the $2 premium. The trade-off is clear. The investor pays $2 to limit the downside below 45. If the stock never falls, the insurance reduces the return. If the stock collapses, the put prevents a much larger loss. A strong response should show the formula, state whether each answer is payoff or profit, identify the unit, and explain the purpose. The calculation earns points. The reasoning explains why the strategy belongs in the portfolio. Here are 5 common options mistakes, and each one can create a surprisingly expensive lesson. Mistake 1 is confusing payoff with profit. A call with a $5 payoff is not necessarily profitable. If the premium was $7, the position lost $2. Always calculate payoff first, then include premiums and transaction costs. Gross payoff likes publicity. Net profit handles the bank account. Mistake 2 is forgetting that writers have obligations. The call buyer can let the option expire. The call writer may be required to deliver the stock. The put writer may be required to buy the stock at the strike. A small premium can be compensation for a much larger contingent liability. Before writing an option, identify how the obligation will be funded and whether the position is covered, cash secured, margined, or naked. Mistake 3 is calling covered calls risk-free income. The call is covered because the investor owns the stock that may need to be delivered. The stock downside is not covered. The premium cushions a decline, but does not prevent it. In a major sell-off, a covered call portfolio can still experience substantial losses. The premium is a seatbelt, not a force field. Mistake 4 is ignoring strike and expiration. An investor can be correct that a stock will rise and still lose money because the strike was too high, or the premium was too expensive, or the option expired before the move. Direction's only one dimension. Magnitude and timing matter. Options are the rare market where saying "I was right" may be followed immediately by "and I lost everything I paid." Mistake 5 is ignoring volatility. Option premiums reflect expected movement, not just direction. A stock can rise after earnings while a call falls in value if the move is smaller than expected and implied volatility collapses. A long straddle can lose even after a noticeable move if the combined premium was larger. Buying volatility at any price is not a strategy. It is enthusiasm with an expiration date. Several related errors deserve attention. Do not forget that many listed equity contracts represent 100 shares. Do not assume the bid or ask shown on the screen is the price available for a large order. Do not ignore early assignment risk around dividends or deep in the money positions. Do not hold a position into expiration without understanding whether it settles in cash, results in stock delivery, or creates a margin requirement. Finally, avoid strategy name confidence. A spread, collar, or covered call can sound controlled while still being poorly designed. Read every leg. State the maximum gain and loss. Check the break even. Ask what happens if the underlying rises, falls, or does nothing. Then ask whether the strategy still serves the investor after cost and taxes. The easiest errors usually come from skipping fit, risk, cost, or assumptions. Options reward precision. They are not known for grading on effort. Let us pause for the knowledge check. A put option gives its holder the right to do which of the following? A. Sell the underlying asset at the exercise price. B. Buy the underlying asset at the exercise price. C. Receive fixed coupon payments. D. Vote for corporate directors. Take a moment before answering. Focus on the action controlled by the holder. The correct answer is A. Sell the underlying asset at the exercise price. A put establishes a sale right. If the market price falls below the strike, that right can become valuable because the holder may sell at the higher contractual price. The holder is not required to exercise. If the market price remains above the strike, the put can expire without exercise. Choice B describes a call option, which gives the holder the right to buy. Choice C describes a bond-like cash flow, not an option right. Choice D is associated with common stock ownership and corporate governance, not with a standard put contract. One memory aid is that a put lets the holder put the asset to someone else at the strike price. A call lets the holder call the asset away at the strike. The language is not perfect, but it is considerably cheaper than learning through an accidental assignment. Now add one more layer. The right to sell does not guarantee a profit. The put buyer must recover the premium. If the strike is 45 and the premium is 2, the put breaks even at 43 at expiration. Below 43, the long put has a profit. Between 43 and 45, it has a positive payoff, but a net loss. At or above 45, it expires with no payoff and the premium is lost. That distinction between contract right, payoff, and profit is the foundation for the quiz and for every strategy that follows. Let us close Chapter 15 with 3 takeaways. First, options reshape payoff distributions. A call creates upside exposure with a limited premium at risk. A put creates downside protection or bearish exposure. Combining options with stock or with other options can create floors, ceilings, ranges, and volatility positions. The important result is not the strategy name, it is the shape of the payoff. Second, premium separates payoff from profit. An option can finish in the money and still lose money. Calls break even at the strike plus the premium. Puts break even at the strike minus the premium. Writers receive the premium but accept an obligation. Every calculation should state whether it is per share or per contract and whether it includes the initial premium. Third, strategies must be evaluated by maximum loss, maximum gain, break even, and purpose. A protective put buys downside insurance. A covered call sells some upside for income. A straddle buys movement in either direction. A spread exchanges one part of the payoff for a lower cost or more defined risk. A collar creates a floor and a ceiling. There is no free hedge and no free yield. There are only different combinations of rights, obligations, and premiums. The homework after this chapter is the option payoff and strategy worksheet. Show each leg separately, calculate payoff and profit, identify the break-even point, and explain the investor objective. A clean table is often more persuasive than a paragraph that has become emotionally attached to the strategy. The discussion asks whether options are insurance or gambling. The strongest answer will explain that the same instrument can serve either role. A diversified institution buying index puts to protect a known liability is using a different process from a trader repeatedly buying short-dated out-of-the-money calls without a risk budget The contract is the same. The purpose, price, and position sizing are not. The quiz contains 10 auto-graded questions on contract rights, moneyness, payoff, profit, and strategy interpretation. Before submitting, check 3 things. Did you include the premium? Did you identify the holder or writer? And did you use the correct strike relationship? This chapter also creates the bridge to Chapter 16, Option Valuation. Expiration payoffs tell us what the contract will be worth at the end. The next chapter asks what the option should be worth before expiration, when time, volatility, interest rates, dividends, and hedging relationships all matter. Finish with the question that should follow every options recommendation. What fact would change my recommendation? A different volatility estimate, time horizon, tax consequence, liquidity need, or loss tolerance can change the answer. Options are powerful because they are precise. That precision is useful only when the investor is equally precise about the job.